what's going on in markets?
I think it would take a month just to summarize last week. I'll try my best. There is a lot going on. It's mainly geopolitical driven. So, we started the year with the market thinking we're going to stay in a Goldilocks kind of scenario in which probably the US is going to enter what people call the Trump boom, which is a combination of the big, beautiful bill that, gives tax rebates to consumers, companies that can actually take their R&D expenses of taxes, help in terms of affordability, which Trump has promised and may not come, and in the meantime, inflation under control. A kind of Goldilocks where you got growth, inflation is under control, and growth is accelerating, and the benefit of growth actually spreads to middle and lower income people. So the market entered the year really bullish, growth outperforming, value doing very well. Anything, basically pretty much everything aside from defensive sectors and quality outperformed, right? And consensus trades worked very well. And then geopolitics got in the midst of it. Yeah, mainly was Trump self-inflicting some damage to the US credibility. So basically we had Venezuela, which in reality was one of the most amazing operations we've seen from a purely military basis. A lot of controversy around it, but there the logic is quite clear. Venezuela had become basically the banking system for Iran. And we know Iran is linked to China in terms of providing oil at a discount. Also, China had de facto been controlling the Panama Canal to Hutchinson for a few years now. So, it was becoming challenging for the US, right? So what the Trump administration is trying to do, which may or may not be successful, is follow the template we saw in Chile when Pinochet regime was taken down. There wasn't a change of regime. What happened was that Pinochet stayed as head of the military. What happened was that the regime stayed in place and there was a transition. And the way they transitioned to democracy was that they basically allowed the people to keep the money they stole. They allowed the elites to participate in the new world, right? There were only 2 or 3 people that were arrested or had to flee the country. The rest of the system stayed intact, but slowly transitioned towards democracy. And what they did was to take out Maduro, which was the face of the regime and not necessarily the strong person, to show the rest of the regime that they can go there and take them out anytime, right? And therefore, kind of ensuring compliance in this transition. Now, we'll see how it's going to go, but they also started going after the shadow fleet that Russia uses to sell oil and Iran. So by doing this, they, they put a much tighter screw over Iran and Russia and therefore China. Again, it might not work, but this allows the US to control 60% of oil production, basically, right? So it's big. And if it works, it's going to be huge for Venezuela and Latin America because you have a country that needs to be rebuilt from scratch. And that's a big boost in terms of fiscal, right? Because you will create jobs, you will create wealth. It will be American companies, but there will be Venezuela workers. Again, there is a logic. It's going to be difficult to be executed, but you can see how this geopolitically benefits the US, benefits Latin America, punishes Cuba, punishes Iran, and China indirectly, right? Then Hutchinson was forced to sell the Panama Canal to an American company. Again, this is big news, was barely reported, but again, gives the US control of the Panama Canal, in line with what the White House said they were going to do in their national strategy document, where they were saying, that they were going to go back controlling, instating the Monroe Doctrine. All good. Iran kind of revolution starts, and even there, the approach is the right one, which is you can't have regime change in Iran. There will be chaos if you do that. Iran is a very dangerous country, right? A dangerous weapon. You can't allow to have what you had in Syria or Iraq in Iran, right? It would destabilize the regions. I think there the strategy as well was a very rational one, which was to slowly tighten the screw on the regime. And the aim is basically to decapitate the Islamists away from the army. So break the link between the Iranian army, the RGC, and the Ayatollahs, right? Once the army stops defending the regime, you can go in an Egyptian kind situation where the army controls the country, all the extremists have gone, which means you lose Hezbollah, you lose Hamas. I mean, it would be the end of wars in the Middle East, right? Again, very ambitious. We don't know where it's going to get, but the strategy makes a lot of sense. How are they putting pressure? Taking out Venezuela, they took away their access to banking. They took away access to passports for the Iranian guards that were using that to go over the world. You are cutting the the banking for Hezbollah and Hamas, and then they did the bombing, and now they're moving a lot of military assets to the area to put pressure on the regime. So, and they're enforcing the sanctions, and that will lead eventually to bank collapse. So it won't happen overnight, but again, you can see a path. There is a logic. It makes sense. And then the Greenland thing comes. That makes no sense. And frankly, it's nuts from my point of view, in the sense that I understand why he wants to do it. The timing makes no sense. The way he has done it makes no sense. And you just create a real fracture. I think it's the first time I've seen Americans heckled in Davos, right? Lutnick had to leave the dinner in Davos because he was heckled by the people there, and there is a real animosity towards the US, which wasn't necessary, right? And for all the misgivings of Europe, for which I agree with Trump for the most part, I think it was completely uncalled for, and you can't just take a piece of a country away, right? I mean, you cannot do that. So that has been a spanner in the work, and I don't know what the consequences will be longer term, but a lot of this animosity Trump is creating is having effects. Look at Canada doing the deal with China. Look at Europe, which may actually turn to China. So it's creating an issue, right? Also because at the end, the US benefits from having the reserve currency. These things don't happen overnight, but once you lose trust in a government, and in a way you can see it in the way the foreign central banks have been accumulating bonds and slowly selling treasuries, people are buying less dollars, right? So once the rest of the world loses trust, it doesn't take a huge amount for things to go badly or sour quite quickly. Again, we're miles away from it. It might never happen. We're just planting question marks, which there were no need to be planted, right? So nothing has happened concretely in markets, right? Nothing really moved in the end. But I fear we could have the resurgence of risk premiums in a lot of area. And anyway, we're seeing gold go higher and higher, which typically is never a good sign for inflation globally, right? So, and also this created a lot of question marks in terms of energy as well, right? Especially for Europe. Again, the Trump administration, I think, had done all the right things in terms of energy policy. They started the Operation Warp Speed, basically the same concept that led under the Trump administration the vaccines to be approved so quickly. They are going after all energy sources to try to catch up on the energy generation ability of China, which had grown massively, the ability to produce electricity, while Europe went down and US stagnated. Why? Because you need energy for AI, right? So there again, there was a very clear path for energy and energy development. And also was a clear path for, US controlling things like the oil, for example. I fear that this political situation may have also posed question mark in places like Europe that, is supposedly going to get a lot of supply of gas coming from the US. I don't know whether Europeans are going to go through. They've put on ice the trade deal already. So the repercussions are not evident right now in markets. Nothing has really happened. But I fear that we're posing the basis for fragmentation trends that we cannot, once they start, really foresee where they're going to end. And they're definitely not priced.
A few years ago, famed investor Ray Dalio put out a book called The New World Order. He talked about this in YouTube videos. He's talked about this a lot in speeches about the different economic superpowers in the world and how they've evolved over time, from the US and its amazing growth now to what used to be the British Empire, or whatever it may be around the world, and the superpowers, the currencies, the influences that those economies had. And there's common belief that the US has been at its greatest, and that at some point in time that China will overtake it. This was kind of seen, 5 or 10 years ago, when both Russia and China tried to have their currencies as the new world currencies. We've seen formations of countries with major oil trying to form coalitions in order to make, have major power over the world and get other countries to work with them. But more recently, yesterday, Mark Carney put out a speech to the World Economic Forum, in which he was basically saying that the countries like the US, these superpowers, have been just telling people what they need to do, but actually calling for the middle countries to form coalitions economically and basically be stronger together in order to have more influence on an economic level, rather than just simply undercutting each other. Alongside that, you've got Ken Griffin speaking also at the World Economic Forum, talking about Trump's tariffs, in which he's saying that despite Trump wanting to encourage more manufacturing in the US by stopping the competitors abroad, it's actually harder to encourage mass investment because both the Trump term only being another 3-4 years, as well as, manufacturing plant can take 7, 10, or even 20 years to build.
They don't know what's
So
going
it's
to
not.
happen after Trump. Yeah.
So they don't know what's going to happen under Trump. So despite
Or
the
after
breaking
Trump.
of political, or after Trump, so despite the breaking of political alliances with the US and Europe and kind of this interchanging thing from being allies to, being whatever place they're in now, what this looks like on an economic scale in terms of capital flight outside of the US, where do you think investors should be looking, both from a business standpoint, but also from an equities and financial standpoint? Do you think people should still be investing in the US versus internationally? Do you think capital should be held? Like, where is the safe place to put money, and where should investors be looking for the long term with so much uncertainty at the moment?
Safe place to put money is definitely still gold, because that protects from inflation, right? And because there is a trend. So if you look at the Chinese central bank, they are below 10% of gold as reserves, right? So I believe that trend for now continue. In terms of allocation, if you look 12 months down the line, I still think the US is still the best place to be, frankly. I don't understand Mag 7, so I cannot talk about Mag 7, but there are a lot of pockets because of growth and all the investments in energy, data centers. There are a lot of pockets in the US that will outperform. The other area, despite all the doom and gloom in Europe, the German stimulus is coming, and it's substantial. It's slow, it's going to take a while, but it's coming. So anything, and I know this has been abused, but anything that is defense, that's a structural trade in Europe. They will have to spend more in defense. And anything that has to do with infrastructure, right? Because that's what Germany needs to get their act together. So those are also areas. So I wouldn't think in terms of raw geographies, more in terms of pockets within geographies. And then everyone is very bullish emerging markets, which I broadly agree with. The issue is there are a lot of elections, right? So if you look at Brazil, where everyone is bullish, there are elections at the end of the year. So a lot will depend on how elections pan out. But I think, again, unless we get major upsets, it should be a relatively good year. The first bump can come in March when you have the big issuance for the hyperscaler, for the capex. That's going to be a big test for the market because there's a huge supply of credit. Broadly speaking, if you look at the macro picture globally, we're looking at a very still healthy place, right? What Dalio is talking about will definitely happen. The point is there are very long-term trends, and we see them happening, right? But they still don't really have the impact because at the end there is growth, right? And the dollar is depreciating, the US is growing. So, that is less of a problem when you grow, right? So again, we'll see. We'll see how Japan goes, for example. It's all in theory. For now, I wouldn't necessarily panic. And
just to jump in there real quick, what's your view on people buying less US treasuries and buying more international treasuries, and also gold and silver becoming a large proportion of what banks are holding?
Gold for sure. The fact that Europeans can sell treasuries to buy European bonds, yeah, they can do it, but you're kind of shooting yourself in the foot, because if the 10-year treasury goes up, the BTP, the OAT will go up way more, right? And if you're the Swiss central bank, which have rates at 0, what do you do? Right? So I'm not sure. For now is actually a realistic prospect. Europe doesn't have the growth. And again, we have way more debts than the US, right?
What do you think will be the overall impact of more innovations within banks? So, for example, the Trump administration is trying to cap the amount of credit that can be taken out by consumers in the US. Do you expect more innovation from the Trump administration on banks?
I think like everything with the Trump administration, you need to take away the Twitter and the headline and see what they actually make sense. Because at the end, it's an administration that's got a lot of competent people in, right? So they are actually not going to do dumb stuff. Trump needs to, he's right. He's very abrasive and need to appease his base. There are the midterms, and there is an issue of affordability, whether it's electricity, whether it's credit, whether it's mortgage costs. So there is an issue of affordability, and things will have to be done. I don't believe they're going to do 10% cap on credit. That would be idiotic. It's not going to happen, because at the end, Bessent is a very incredibly smart person, right? So is the energy secretary, right? Decisions that then will be taken in the right way. Remember, this administration is probably the most proactive US has seen in terms of reaching out to business people and getting things done using, the CEOs as reference. Main Street versus Wall Street is a theme in the US. 100%, I'm sure there will be initiatives that will be taken to help Main Street versus Wall Street, but I don't believe they're going to do things that in the end are really harmful for the system as a whole economically. For example, the idea that was floated of having the Mag 7 actually pay for the electricity they produce in a way that they need for the data center, in a way not to weigh to the people that live in the area where the data center are built, it's absolutely fair. So what the administration is doing is, okay, we have 250 billion of loans we can give you, so you build your own small modular reactor, right? And you don't get electricity out of the grid, for example. A lot of these things will end up helping the consumer, right? But they don't hinder the companies, right? And then, yeah, you got the announcement on defense they can not do buyback, but it's also a way. What they're trying to do is a bit like, I'm not saying what China does, but a bit of state capitalism in the sense of looking at what the system needs and try to address the capacity of the different buckets towards what the system needs, thinking that you have to benefit at the end the working person rather than just the CEO, right? It's a very difficult middle ground. And again, with Trump, you always need to be careful reading between the lines. But I believe after having interacted with Wright, Besson, a lot of the people, Sachs, these are very, very, very smart people. They don't do stupid things. I don't believe it. Let's see what they do. There will be a shift towards Main Street, and it's fair because the system won't survive otherwise everywhere. But I believe it's going to be done with grano salis rather than, with big announcement. I think there's zero chance that 10% credit cap goes through the way it's been floated. They will find either it's going to be, I don't know, they were thinking about doing a Trump card, right? The credit card companies that actually help customers that are in trouble. Some kind of program, right? Rather than capping fees at a certain level.
I'm not going to use the name because I thought the name was kind of harsh and rude, but I saw an interesting news article earlier in which it was saying that essentially what Trump does is he pushes to the extremes of what people think, which moves the market a certain way, which then when he wants to actually get a solution in the middle, it seems much more reasonable. So take Greenland, for example, by saying he wants to take Greenland, everyone's like, no, what are you doing? You're going against everything. When actually his main goal is to get more military bases on the island. Or with credit cards saying, I want to go to 10%. They're like, no, we don't want that. So then maybe 15% or maybe capping at 20%.
The market is not reacting anymore. So if you think about it, Saturday, I personally thought Sunday, that Monday would have been Armageddon. The market was down 1%. And at the end, we went down because of Japan. Like Tuesday, we went down because of Japan, right? So the market has learned from last April. So this is going to be less and less effective. And this kind of behavior has a big cost. And Greenland is a perfect example. What we've seen at Davos is unprecedented. I have never seen Americans heckled in the street at Davos, okay? Or such a harsh reception. I mean, today Musk did a presentation. The crowd was quite hostile at the beginning. They barely clapped, right?
Saw that, yeah.
So there is a cost, right? That cost, and also, the rest of the world functions differently from America. America is very transactional for everything, and I think Trump is a quintessential American businessman, right? It's all about doing stuff. It's a real estate developer, so it's got that way of negotiating. The costs are high. I think Greenland is probably the biggest blunder I've seen him commit. I'm telling you, the shift that this thing has created in Europe are profound. Even the biggest ally of Trump in Europe are now distancing themselves from him, right? It's become kind of radioactive. There was no need for that. And again, he gets things done in this way, and it always works for him. That's why he's continuing this way. But I think because people now know works this way, it's less and less effective, and the negative effects now are starting to become bigger than what actually gets out of it. Again, we're going to see it in risk premium at some point.
What are you seeing as the key focuses for banks then? I mean, we saw that Goldman Sachs sold their consumer business with Apple to JP Morgan. Are there any other big things like that you see banks focusing on in the next 12 months?
Lots of equity capital markets M&A. There is a lot of M&A coming in Europe, in US. There are a lot of private equity companies that last year, because of all the hoo-ha around tariffs and then the max, all the issues around private credit, didn't really manage to exit from their stakes or do as many M&A as they could. I think banks are really banking on the fact, or at least we're banking on the fact that this was a year for all that to happen. So and equity capital and debt capital market because of the issuance. Then remember, you have major IPOs. You have SpaceX and you have Anthropic. Those two IPOs together are already bigger than anything we've seen, right? So there is a lot that is happening. And also, I think we're going to see more deregulation from the White House. They will continue to get rid of bureaucracy. And I don't know if you heard Griffin when he was talking yesterday at Davos, now saying the big difference in having to worry less about regulation and having to spend time just dealing with stuff that adds no value simply because you have 7 different bodies regulating the same thing, right? To having an administration that cuts that to the bone. I think there's more to come that will advantage bank. I wouldn't be surprised if we see capital relief across the board. So banks going down in terms of CFI buckets, freeing a lot of capital. And consider that JP Morgan is bigger than the entire banking index in Europe, right? So freeing capital gives JP Morgan the ability to maybe go and buy a bank in Europe. It's European banks are peanuts compared to the American. So also that helps American dominance, right? So yeah, the problem of banks is that they're extremely expensive. That's true for the whole market. I think we're looking at an extremely good year again.
You mentioned a lot of the point in which Trump's negotiation strategies, more based on real estate, aren't working as much because people know the moves that he's going to make pushes that extremity, and so the markets aren't just going off a hunch, but actually waiting to see where the real thing comes from rather than just signal of it. Do you have any fundamental core theses for the year of where you think the market isn't priced in yet? And what do you think the catalyst will be for that to have an impact on financials?
What is the lot? We're pricing Goldilocks, right? So there is a lot that is not priced. We're not priced for inflation that starts rising again, although I don't think happens this year. It's more of 2027 issue. So what happens if inflation starts rising and the long end starts going up? So that's one. What happens if growth in US is not as strong as everyone is expecting? What happens if something goes bad in the Middle East with Iran? Because that could create another shock. Is there really going to be a rupture by which Europe, I think probability of this are close to zero, but could there be a rupture by which Europe switches to China in a more evident way? Are we going to have a serious issue in UK? Because Starmer is replaced in May by Rayner or one of these God Save Us Miliband, right? And therefore you have a massive spike in rates. And people start taking money out of the country. So there are a lot of things that are not priced, right? But for me, the main things would be, right now we're pricing growth with no inflation. If that equation changes because you get much lower growth or you get much higher inflation, then you're going to have a violent shift in the curve, which, of course, cascades through all asset classes. And then, of course,
have you noticed
we're not pricing issues with the issuance of the hyperscaler, because the amount of money that needs to be issued in March is huge, right? So right now, we're not pricing credit is as tight as it gets. But what if actually that is too much for the market to absorb, right? So that's, to me, that's the key point this year of the markets.
I think there's been a big trend in the last couple of years with brands like Klarna, in which you have this kind of buy now, pay later type of mentality. But not only that, the attitude towards risk, particularly for younger people, is extremely high at the moment, both in terms of sports betting, gambling, in terms of betting in the stock market, but also with the novelty of prediction markets like Kalshi, for example. Have you noticed that younger generations have started to move more of their money outside of more traditional banking systems and put them in sites like Robinhood? And do you think that's a threat, that the younger generation is trying to get their interest based on money that they're betting or putting on prediction markets or through the stock market? Or do you think that the younger generation will still keep a bit of money in more traditional bank accounts?
They will, because you always do, because it's at the end it's safer. But yeah, that's definitely a trend and I think the mainstream banks are a bit slowly trying to find their own answers to that. But I don't think that trends will revert, right? Because that's it's just a new trend that is not going to go back. Just a different way of looking at risk, right? And also makes sense considering that we have 20 years of, aside from COVID, which was at the end, stock market-wise, not a very long correction. We had a very long time without having real issues, right? If you bought the dip every year since 2008, you always made a fortune. That makes a difference. If you haven't really lived the 2008 or 2000, you're not going to have the same risk tolerance that people that have lived through those two phases will have, right? So I don't see anything different from, what I would be if I hadn't gone through Lehman going bust or the year 2000. So yeah, definitely the putting money into new form of store of value, whether it's Robinhood because you trade or Bitcoin, I don't think those trends will change at all. I actually think Polymarket could become a new all-encompassing asset stock exchange, right? As it becomes more liquid, where you can actually attract more and more liquidity and therefore being able to do the equivalent of what you do on stock on pretty much everything, right? And it's quite incredible how even CEOs now, they look at Polymarket, right? I mean, at Davos, there were people constantly referring to Polymarket odds, right? Whether it was Greenland or whether it was Iran regime falling. Credibility that Polymarket has acquired in a short space of time is quite staggering.
Yeah, I've been using Kalshi and Polymarket. I've never actually placed a bet on them, but I use them quite often to look at the odds of things because I think when people put their money where their mouth is, just as the point you just hit, it really says a lot. And the ability to get things right, particularly as shown by the presidential elections, it was more accurate than the polls. Where have you seen banks try to innovate in the past that hasn't gone as well? Because when I look at things, I mean, I'm pretty young. I was only 4 or 5 years old in the 2008, 2009 crisis. But at the same time, I'm seeing so much money being poured into both sports gambling, more traditional gambling, prediction markets, etc. But I'm not seeing whether there's, I don't know if there's anything going on in the background that's dodgy. I hope not, which doesn't impact the global economy. But what typical things have you seen where everyone's going, oh, this is the thing that, banks have to, from banks to top investors to venture capitalists, whoever it may be, we're like, you need to invest in this thing. What have you seen traditionally in the past like that? And do you see anything in 2026 that's similar to that you're more cautious of?
Yeah, there's been a huge wave of private equity and illiquid investing, right? That is huge. Not much in banks, because regulated banks, because of regulation, in my opinion, have become safer and safer. It's more in insurance and private equity and alternatives, right? But if you look at insurance balance sheet now, you have sizable part of the balance sheet that it's effectively mark to model. And a lot of it is the result of the regulations we had post 2008, where especially in Europe, insurers were basically discouraged from investing in equity and, in a way, in certain area of credit, and therefore to make returns, because rates in Europe were zero and negative, they invested more and more in very liquid products, whereas infrastructure projects or private credit type investments. That's the real issue could come, right? But the only thing that can make that pop is interest rates and a major recession. Barring those two things, we're fine. And I've been calling for this issue to come to the fore for a while now, but it hasn't happened because at the end, interest rates have stayed well behaved and global economy has been buoyant at the end, right? Now, the global economy has been buoyant because of government debts. So, yeah, government replaced, during COVID, if you think about it, debts went up massively because government subsidized the world, right, to stay on the sofa. So that's a big elephant in the room, right? Government debt and private credit in balance sheets. But I think it's less of an issue for banks because they're really tightly regulated. The next crisis is not going to come from a bank.
I saw another great quote from Ken Griffin from the Davos speech in which he said that the US government spent more money in the COVID pandemic as a percentage of GDP in terms of printing money than it did in World War II. Yeah. And I just think it's just such an unbelievable statement. On that point, why do you think that, from 2022 up until even the end of 2025, there was this big talk of a US recession, both initially through the debt ceiling, but then people kind of thought there'd be a lack of growth and also a lack of earnings that would, Nvidia earnings, for example, at the end of that last year. I know you're not focused on tech, but there was this big belief that there'd been such high valuations and they weren't sure whether Nvidia actually had the earnings to back it up, similar with Apple, and they did. And so it was like, oh, okay, these warnings have gone. So why do you think debt was such a big issue over the last couple of years? And why
because
is it now
the market has been expecting the bond vigilantes to show up in a way, right? And put a brake on the ability of governments globally to continue to borrow. In reality, growth has been very resilient in Europe. Until you get growth, you have no issues. And at the end, global growth has been fine. If China stops or the US stops, then we're going to have big issues. But until then, we're fine. And it's not going to be this year because, again, I really think we're going to see a Trump boom in the US because of all the stimulus that arrive from every direction. 27 could be the year because at that point, the stimulus wanes, growth will tail off inevitably. a lot of the sugar rush in Europe goes away. So and inflation could start going up again because tariffs have a delay impact. And also I think in US at least, the administration has been trying to put a lot of pressure on companies not to raise prices and to eat actually the difference in tariffs. We could have a 2027 where growth slows and inflation goes up again. So that could be the moment where we start seeing issues. Again, to me, what to watch is the credit issuance in March, because again, that could be a crunch point. If we are fine after that, 2026 is going to be.
But on the idea that Trump keeps trying to devalue the currency, he wants lower interest rates to keep pumping money into the US economy to get it red hot. Even if the growth does come, is there a threat that having too much money in the economy could lead to it like going too fast and spiraling out? Like, what sort of risks do you see on that end?
If you listen to him, I mean, I know he rambles a lot, but twice yesterday and today said that interest rates are fine where they are, right? I think what he's trying to communicate in the wrong way is that the Fed has been always too slow, right? And it's true, because we're the central banks that allowed inflation to go out of control, right? And his point is, if the labor market is slowing and productivity is improving, and therefore you don't see inflation, if there is a sign of weakness, you should cut rates, right? Now the sign of weakness are not there. The dollar will weaken. I don't believe dollar will weaken as much as people think, simply because growth is going to be so much stronger than the rest of the world. So I don't think we see a repeat of last year in terms of dollar devaluation. So again, we're treading a fine line and we will see the data, but I don't think we're gonna see major issues for now.
I saw a interesting interview. I think his name is Chris Hone of TCI Management, and he was on I think it was the Norway investment management interview. I think it's called like In Good Company or something like that. And I was listening to that interview yesterday, and he was essentially advocating for this idea of investing in 10 to 15 stocks or 10 to 15 things at a point in time, and trying to own like real assets and also things that either have a monopoly or an oligopoly, whether it's like toll roads or whether it's an airport, basically things that aren't easily replaceable. On that point though, with things like gold, with things like banks, many of the banks are at their highest valuations they've been at in years compared to their earnings. At the same time, gold and silver are up such high amounts. And despite there being this kind of like unspoken rule in finance that gold is this kind of like thing that you buy when you think an inflationary environment is coming about, do you see there being this potential threat to valuations of banks, to valuation of gold getting so high? Like, at what point in time do we say, actually, we need some form of other investment, because everyone's got this same idea of gold, silver, banks being this safer investment, but actually this thing has been overplayed?
Yeah, but that you can see that of 90% of the market at the moment. The market is overvalued everywhere and almost in every pocket. So gold is a store of value. So you buy gold not only because of inflation, but you buy it because you believe there is a potential of fiat currencies being under threat because central banks buy gold to diversify away from the dollar. So there are a lot of reasons why gold can continue to go. Banks are in the US are expensive. In Europe are fairly valued, right? So the problem is there is nothing cheap in the market. It's really difficult to find cheap. You have to go in the pockets, right? Everything that the industrials will build data centers and provide all the chain around data centers, they're going to have plenty of growth and you can justify massive upside from here. The grid operators that, will have to put CapEx in to upgrade the grids. So there are pockets where you still can say there is value, but it's there now very few and far between. That's what I'm saying. We are at the ninth inning of this. So you need to be very selective.
I saw a really interesting thing again from this Davos. I watched quite a few of the interviews from Davos over the past couple of days, and it was Larry Fink interviewing Elon Musk. And the reason I found it so surprising is I feel like so often you look at major bank CEOs, maybe with the exemption of both the CEO of Goldman Sachs, but also JP Morgan. But if you look at a lot of CEOs or senior people, definitely research people, there's this extent to which they all kind of form similar opinions, because if they have the same opinion and they're wrong like everyone else.
Yeah.
But if they have a different opinion and they're wrong, then it's like, what the hell, you've done something really wrong, right? So with these enormous banks, but also enormous asset managers, there's this thing of constantly being cautiously optimistic, because if something goes wrong, you can say you're cautious, and if it goes right, you can say you're optimistic. But Larry Fink said something with his speech with Elon Musk, which was interviewing him, and he was essentially advocating for the idea of investing in growth. So he said that if you've given your money to Elon Musk since when Tesla, I think, reached IPO even sooner, it reached a growth rate of more than 42% a year, which is obviously more than double or even 4 times what the S&P or many of the best hedge fund managers on the planet have done. Why do you think Larry Fink was encouraging this type of momentum and growth investing when he has $1 trillion in assets? And do you think that investors should be looking more towards growth and momentum with these overpriced valuations? Or do you think people should be more cautious in these times of high valuations?
I actually think that because we are towards the end of this mega cycle we've seen, now there are a lot of, on the more defensive and quality side of the spectrum, there is a better way to protect your portfolio, right? Because all the defensive part of the market have actually devalued quite aggressively. But yeah, definitely growth remains the way to go, right? The problem is the real growth companies are typically in the middle, small part of the market, right? The Russell type of companies or the ones that are not even listed rather than, the traditional ones. Although again, it's down to me, it's very idiosyncratic this year, right? There are going to be plenty of industrial companies booming because of data centers and all the AI capex and all the energy, right? Build up, especially in the US. So I think it's really a year where to look at the money is made by looking at themes and then finding the best way to express themes rather than going by necessarily by sector or by factor. So a theme is, AI capex. So you go and look at all the vertical AI capex, and in there you find the ones that can really benefit from that. Grids, and then you look at everyone that participate to improving and strengthening grids and energy, right? The US is giving a big push to nuclear. So anything that has to do with nuclear energy. The US is building the first uranium enriching plants in its recent history, right? So again, this is a big push. It's going to benefit an all vertical. So I would go more, again, looking at the themes that the different governments are pushing. Like in Europe, defense is very obvious, right? It's overbought. Hopefully we get peace in Ukraine and that whole sector comes down aggressively. But, Europe has suspended defense. No if, no buts, right? That's a structural trend. It's not going to change. So you go and look at what's the best way to play that, right? Drones. Europe needs drones. Who makes drones? Who makes the part for drones? Again, that's the way I would approach it rather than banks or, industrials or chemicals. You really need to go in the verticals of everything. And because governments are telling you where they're going to spend the money, it actually makes it easier, right? It's probably the easiest year for thematic investing I've seen in the past 5 or 6.
But on that notion, despite what we said previously about Trump changing his mind with going to extremes, going in the middle, doing something versus not doing it at all, I feel like we're at a very interesting moment in time where the leader of the biggest economy in the world, which obviously has a global level of impact, is doing so many things on almost a 10-time-a-day basis, which has such a profound impact across a variety of industries. So I'd say in the past 10 to 20 years, and please correct me if you think differently, there was this very much focus on rational type investing in which if industrials are undervalued, invest in that. If financials are overvalued, short that, etc. Whereas now it's not just about the rationality of the market of where the money should go, but it's where the money can go because it's being restricted by tariffs, by trade disagreements, through wars, through battles. So how should investors approach investing both rationally with fundamental investing views, but also with the knowledge that a tariff, disagreement, or major political decision can be made at any moment in time, at any day or any time?
Yeah, but still we know what governments are going to do. Trump told you what he wants to do, right? I have to say, if there is one thing credit to the Trump administrations, they do what they say they're going to do, right? And he's in a rush because he wants to create a legacy. Only as, he's probably, after the midterm, he's going to lose a lot of abilities to do anything. He's got 3 years to do tons of stuff. So he's pushing his agenda. But we know what his agenda is, right? We know where Germany is going to spend the money, right? The money is coming. We know where they want to spend it. So I think you just make it simple, right? You go where people are telling you the money's going. And this way you can forget about noise, right? So if Trump is telling you they're going operational warp speed in energy, right? And they're working on grids and they're doing nuclears and they're doing gas and they're doing fracking, they told you what they're doing, right? So you go and look at that and you look at every company that can benefit from that, right? Vertically, horizontally. AI capex, right? everything that has to do with that. German stimulus, European defense, European renewables, which, are a massive gift to companies because they are done in a very stupid way. So again, I think it's about keeping it simple. Just follow what the governments are telling you they're going to do. You're going to make money.
So on that basis, in terms of the Trump administration doing what it sets out to do, Ken Griffin also noted that Japan had a Liz Truss type of moment in terms of what was happening. Yeah, exactly. So what do you think that Japan did to screw up, and why are countries not copying the US and doing what they set out to do, or at least what did they mistake to do, and that's led to these awful results?
So Japan has an issue of has few issues, but they have a very high debt to GDP. They have an aging population, so they have a series of problems. And what happened was that there are elections coming, and the main candidate basically promised to abolish sales tax. It was supposed to be for a year, but the market knows that once you get rid of a tax that's 20% of the products, you're not going to put it back on after a year. So the market start questioning where are you going to find the money. And Japan is in deeply negative interest rates because they've been so traumatized by being in deflations for 20 years. So now they're been running hot for 2 or 3 years, right? Inflation is high and interest rates need to reflect that. So if you're going to give another boost to consumptions and you're going to basically do spending that is unfunded, rates will react. So we had a massive knee-jerk reaction move. I don't think any dramatic is going to happen. There is an auction on Wednesday of the 10 years and then 40 years on the 3rd of February, election around the 8th. At the end, Japan can easily be cured by the Bank of Japan that just hikes rate or talks hawkishly. I don't think it's going to go out of control. But yeah, it's another example of a country that is over-indebted. And, the bond vigilantes, when you have too much debt, they will rein you in. And that's what happened. So it was a warning shot from the bond market to the Japanese government, essentially. And the Bank of Japan.
Just before going to some more holistic type questions, I was listening to a podcast earlier with Harry Stebbings and 2 other people, and they were essentially talking about this idea of that public markets is where to be, private markets are not the place to be right now because of exactly what you were talking about with these overinflated valuations.
Yeah.
I mean, there's a company called Thinking Labs, for example, with the former CTO of OpenAI who left to go and raise a $50 billion valuation pre-product. And then 2 of the co-founders actually ended up going back to OpenAI, leading to this brain drain from the company. $50 billion, without a product is just absolutely insane.
Yeah.
Why do you think that public markets are so attractive? Do you think they will continue to be? And so a contradictory idea to what I just said is the notion that private companies are getting so big, with SpaceX reaching an almost $1 trillion valuation, OpenAI at $500 billion valuation. So how do you play with these contradicting principles of public markets being attractive according to them, but also private companies getting such high valuations? How do these 2 ideas contradict and also complement each other in your mind?
I don't know too much about private equity because that's not my field of expertise. But in the public markets, you get so many actors globally that it's easier to say that the price you reach is actually a transparent price, right? Where the private credit space, we've seen private equity companies selling stakes from one another at a price that God knows, right? And it's a way not to take markdowns, and it's the way they've avoided losses, even on wrong investments, right? They just keep it passing to each other and maybe mark it down a little bit and then passing to the next one. But again, I'm not a good judge of that because that's not my area of expertise. I just think that from that point of view, the equity market protects you simply because it's very transparent, right? So the price, it's more likely that you get a fair valuation in the public listed market than in the private ones.
I want to go to some more holistic things, both in terms of 2025, 2026, and then the hedge fund industry more broadly. The first one being, what are the biggest takeaways from 2025? Was there anything you're particularly surprised about? And what did you learn the most from in terms of investment strategy from the year?
What I was the most surprised about was how much better retail investors were than professional investors when the whole sell-off in April happened because of the tariffs. The retail investors bought all the way down and they ended up making a killing while the professionals sold, and it took them a very long time to go back in because they were waiting for the Armageddon of the tariffs to reveal itself. And then there was no Armageddon. And little passed through in terms of inflation, while the retail just did what he has been doing for the past 20 years, just bought the dip and they ended up making a lot of money. So I was surprised by how wrong-footed the professionals were versus the retail. And I think it's because the professional part of the market all think in the same way, right? We all apply the same theoretical economic model, which I have to say with Trump have been proven wrong time and time again during Trump 1 and Trump 2. And so people tend to make mistakes together because there is a lot of groupthink going on. And I think there's more groupthink now in a way than what there used to be when there was less transparent information. Because now everyone has got the same access to information. And in a way that's helping people to think all in the same way. While before there was less access to management, there was less access to information. And in a way, there was more variety of views than what you see now. I mean, I was astonished. There was a Goldman conference at the beginning of the year. They've been doing that conference for 34 years. And the more the years go by, the more you see the opinion of the people that are there polarized, right? And all together moving in one direction or the other. It was much more fragmented before. So that was, that's what I learned from 2025. In terms of 2026, 2026 started with a bang. I think everyone made money and made money very easily because consensus has been working very well. So it never lasts. So I wonder what's going to make that go pear-shaped.
Yeah, are there any other particular investments or places to focus on for 2026?
No, for me, it's really follow government. So in Europe is grids, debate about data centers, defense, anything that has to do with German stimulus. In the US, you just take what Trump told you in the program and then apply that to the investment world because they will do it. And forget about the noise, forget about the tweets, forget about the threat, just ignore them because they're 99% of the time just a way to extract concessions, right? Rather than the end of the world. There is one thing Trump is not going to do this year is disrupt the midterm elections. It's just not going to, makes no sense. So anything that goes against that, just ignore because it's just noise, it's a buying opportunity.
What are you seeing as the broader trends in hedge funds in terms of hiring, AI, and how has process changed with the age of AI?
So my personal experience of AI had for now a very meaningful improvement in my productivity because AI helps you to summarize your inbox so you don't need to spend 2 hours to read emails. You can use AI to scan the research. And you don't need to read a 50-page report because AI can just summarize for you, right? And you put the parameters you want and it will tell you what you want to know, right? So in terms of productivity, it's massive. It helps a lot. In terms of hiring, I think, before you used to need different type of people in hedge funds. So you needed a guy that was really good at modeling, right? So the guy that was machine-like in front of an Excel and could build any model. And then you needed a guy that would look at the company, reason on the top 2 or 3 metrics, and then find a problem or find something that didn't make sense, right? So the guy that would think out of the box. And AI get rid of the need for the person that just does the Excel and that's it, right? Because that the machine will do. So it's restricting the hiring more towards the person that can think, can connect the dots, and that can think critically, and they can think outside the boxes. And therefore favors the kids that, in a way, have studied math and history, right? So they studied a STEM subject that creates that ability to be rigorous in their thinking, but then have studied history so they can actually learn from the past and from history, learn, to recognize historical patterns and then help you to connect the dots of what's happening today, which is what the Dalio says in every book, right? If you read Dalio, it says that the most important subject you need to study is history. So the kids that can combine STEM ability with knowledge of historical knowledge, I think in the investing world are going to be the ones that are going to do best. And the ability to connect the dots now comes before the ability of being able to build a model because you've studied finance, right? And therefore you know exactly how to build the DCF. You will need to be able to understand the output of what the DCF number means and what the free cash flow means, not necessarily being the guy that knows how to build the Excel spreadsheets, because AI will do it for you. So I guess the selection is going to go toward one type of person rather than the other. And the other thing, which is more for banks rather than hedge funds per se, is what I've noticed with kids is that a lot of kids don't really have an ability to communicate face-to-face. I have a lot of kids that come from internships, and they are 17, 18-year-old. And while kids that come from boarding schools are perfectly adjusted, they can have a conversation, they can communicate because they're at boarding school, they're in a collegial environment. Now increasingly don't have smartphones in school. So they are still the kids that can have debating, communicate their ideas, can interact in the office. A lot of kids are losing that completely. So the ability to, retain emotional intelligence to me is key in being able to have a career going forward. Again, it's more for a bank than and a private equity than hedge funds, but even in hedge funds that works, you need that, right? So at the end, you have to interact with management, company management.
One of my favorite quotes is from Albert Einstein, in which he says, "If I had an hour to solve a problem and my life depended on it, I would spend 55 minutes determining the right question to ask. Once I knew the right question, I could solve the problem in less than 5 minutes." I want to ask you that question. What are the questions that you're asking yourself in 2026 about your investment process, about what to invest in terms of how you can constantly find the right answer, not just in terms of where to find alpha, but also where in terms of you could be wrong?
So the main questions I'm asking myself this year is, what is the time frame I need to use? Because Chris Son has 3 years money locked in, right? So he can take a position and wait 3 years. I need to make money within a year, right? But within that year, what is the optimal time frame now? Because machines are quicker and quicker, right? So the information gets arbitraged out very quickly. The shorter time you're focused on, the less likely you are in making money. So what is the time frame in which you can maximize your knowledge or your investment case, knowing that you have a 12 months time horizon, right? Is it 12 months? Is it 6 months? Is it 3 months? And I don't have an answer yet, right? Because markets are changing very rapidly. For example, before, you used to make money by getting the earnings right on earnings day, right? And then we started having pre-close goals, which means the companies will start guiding people into earnings, right? So then the game became having the right position into the pre-close goal. And then by the time you got to the earnings, the story would have played out. But increasingly now, the pre-close goal get arbitraged in an hour, right? Also because everyone has the same position. So the ability to extract alpha from that is becoming less and less, right? So now it's more, getting the factor right, getting the theme right, getting the top down, more the bottom up, in a market that is very idiosyncratic. So let's not forget what I said before. So the question I'm asking for this year is, what is the time frame I need to be focused on? Because it's not anymore just playing the earnings.
What are your biggest takeaways from this podcast?
What are my biggest takeaway? I need to look more into the question you raised about young people actually using different forms of investing, whether it's betting or polymarket or sports betting, and moving money into less traditional non-banks. You mentioned Robinhood, right? So a different way of treating everything like a trade, not only stocks. Could be a football match, could be an election. So that is something I would like to look into.
Yeah, I don't know. I'd have to look at the numbers, but just even from a cultural perspective, I'm finding a lot of my friends, the ones that sports bet, will just leave a lot of their money in sports betting accounts. They're definitely losing money over time. They might be winning like 45% of the time, so they think they're winning, but they're not. And then they put more money and leave it in there. A lot of people leave money in like Venmo and like Cash App, for example. But then you also get a lot of people leaving it in their investing accounts in cash because they can often get higher rates of interest. And now you're getting prediction markets. And Kalshi, I'm sure that the other ones that enable you to do this as well, but they enable you can cash in, cash out at a sort of trading rate. And unless you're like an experienced trader, the odds are that you're going to fail. So people are kind of leaving their money in these gambling-esque sites. So that'll be very interesting. The final thing that I wanted to ask is, what is the one thing that you'd want a listener to take away from this episode?
To keep it simple this year, not to overcomplicate things, to eliminate the noise, because there's a lot of noise that's not going to change anything in reality. And Greenland was an example. I was surprised there were people that actually thought the US would invade Greenland, right? It was never going to happen. So literally forget about the noise. Just go read what governments told you they're going to do. Look at where the money is going and then just follow the money. That's it. Keep it simple.
Amazing. Thank you very much, Lia. It was great to talk to you about Greenland, Venezuela, Iran. We didn't talk about Cuba, but that will be interesting to see what happens there. Japan, talking about the Fed and where the money's going, talking about financial companies and both their ability to stay constant in line with government interests, but also potentially looking at new interests such as Kalshi and Polymarket, as well as new gambling sites being disguised as investing sites. I'm interested to see what Trump is able to accomplish in the next couple of years, and if money does capital flight outside of the US, or if people still stick to the US, and what large money managers will do. I'm interested to learn more about growth and momentum type trading, even though there is an inflated amount of money in the markets, and where that goes, whether it follows the governments or starts to diverge from it, as well as seeing if, from Mark Carney's speech, if these middle countries are able to come together to form new coalitions. He was in China over the past couple of days as well to see what the new partnerships are there. It was an honor to chat to you. I feel like I learned a lot. I feel like we've got a lot to take away from this conversation, the personal community, and I look forward to speaking to you again soon.
Thank you so much for having me again. Thank you.